everyone. Today, Shima, Karen, Vivian, and Sammy are going to be talking about the assets under our management. We'll be describing, summarizing, and analyzing these assets for you to better understand them. So just a general overview of what we'll be talking about today. So first, we'll be talking about the stocks in our portfolio. Sammy and I will be doing a descriptive statistics, various rates of return, discussing the arithmetic versus the geometric rates of return, and finally, the correlation on covariance of the stocks. Moving on, Karen and Vivian will be talking about the bonds, Wenham Worldwide Corporate Bond, Hospitality Properties Corporate Bond, the 3-month Treasury bill, and finally, the conclusion.
So among the stocks that we have in our portfolio, we have Walmart, which is a company that engages in retail and business, offering an assortment of merchandise and services at everyday low prices. Next, we have Halliburton Company that provides services and products to the upstream oil and natural gas industry. Then we have Mercado Libre, which is a platform that provides services in enabling e-commerce and digital and mobile payments, mainly in Latin America, in countries such as Mexico, Peru, and Argentina. And last but not least, we have Lululemon Athletica, which is a company that sells technical athletic apparel for yoga, running, and exercising activities.
Moving on to the descriptive statistics, some of the highlights we see are that Halliburton Company has the highest minimum rate of return of negative 58.6%, and Lululemon has the highest maximum rate of return of 61.1%. On average, Mercado Libre has the highest rate of return of 3.2%, but it also has the highest variance of 2.3%. Now I will be passing it on to Sammy to talk about the various rates of return.
The rate of return versus time graphs represent the various rates of returns for the 4 stocks and the S&P 500. In each graph, the orange line, which goes from the period 0 to time t, represents the holding periods of returns, which shows the returns from the stock from 2008 to a given year on a monthly basis. The blue line, which is the returns from the period t-1 to t, represents the periodic returns on the stock. The yellow and the gray lines represent both the arithmetic mean and geometric mean respectively. And as these two means are very close to each other, it cannot clearly be seen on the graph. As we can see among this graph, the usual trend for all of the stocks is that they're increasing, with the exception for the Halliburton Company. As we can see in the top right corner, for this stock, the holding period rate of return has been very unpredictable, with huge increases and huge drops throughout the years.
We will now be talking about the arithmetic versus the geometric mean rate of return. You will notice in both this slide and the next slide that the arithmetic mean rate of returns line is always above the geometric means line. This is because arithmetic mean does not take volatility into account, whereas geometric mean does, giving us a more accurate answer. This gap between these lines therefore shows the volatility of the stock. In our case, the volatility is low because as the lines are close to each other. This is also represented by the graphs on the next slide. The y-axis here shows the variance of the rate of returns, and the x-axis shows the difference between the two means, geometric and arithmetic. As there is a linear trend in all these graphs for the stocks, we can see that the variance is approximately equal to the difference in the means, geometric and arithmetic, and as the difference is almost zero, this also shows that the volatility is low for these stocks.
As we can see in the first table, it shows the correlation between each stock and the S&P 500. And as we can see from the table, Halliburton Company has the strongest correlation with the S&P 500 at 0.68. This tells us that Halliburton Company has the highest probability of the increase in returns as well. On the other hand, Walmart has the lowest correlation with increase in S&P 500 with a correlation of 0.34, which tells us that as market returns increase in the S&P 500, Walmart is least likely to see an increase in its returns compared to the other stocks. It is important to know that while the correlation is relatively low in comparison to the other stocks, there is still a chance that its returns will increase as well. Thus, this explains the positive covariance. As we can see in this second figure, covariance, it is showing the covariance between stocks and the S&P 500. As we can see from the table, all covariances are positive, which means that the stocks have a positive relationship. For example, as the S&P returns increase, the stock returns will increase as well. And in a similar manner, if Walmart values rate of returns were to increase, returns for Lululemon Athletica will increase as well.
So looking at Wyndham Worldwide Corp's bond, it is a level coupon bond with a 10-year maturity, semi-annual payments, and an annual coupon rate of 3.9%. Assuming the face value and the price of the bond is at par, $100, the holding period return for the bond is 47.14% if the bond is held from the effective date of February 22nd, 2013 to the maturity, which is March 1st, 2023. As displayed in the graph on the bottom right, the longer the bond is held, the greater the returns received. Since the coupon rate does not change, the rate generated from one period to the next is constant at 1.95%. The reported yield is 2.62%, and the yield we calculated using Excel is 3.61%. Similarly, the corporate bond for Hospitality Properties Trust is also a level coupon bond with a 10-year maturity and semi-annual payments. The coupon rate for this bond is 4.5%, and the holding period return, assuming that it is held till maturity and was traded at par, is 56.05%. The bond also generates greater returns the longer it is held, and it has a constant coupon rate, so the holding period return from one period to the next is constant at 2.25%. The reported yield to maturity is 4.3%, and the yield we calculated is 4.19%.
Now we are going to compare the two bonds. Comparing the two bonds, it is evident that Hospitality Properties Trust's corporate bond generates a holding period return of 56.05%, which is greater than Wyndham's holding period return of 47.14%. It also has a higher effective annual rate of 4.55%, AIR of 4.45%, and APR of 4.46%, whereas Wyndham's bond has an EAR of 3.94%, AIR of 3.86%, and APR of 3.87%. When choosing the optimal portfolio, the returns generated should be considered, as well as the risks. Since corporate bonds do carry more risk, called credit risk, than government bonds, it is necessary to look at the credit ratings for each bond. Wyndham's credit rating is BB- according to S&P and Ba2 according to Moody's. Hospitality's credit rating is BB+ according to S&P and Baa2 according to Moody's. Therefore, assuming both bonds trade at par, it is clear that Hospitality's bond generates a greater return in the same period and has a higher credit rating, which indicates less risk. Also, the reported yield to maturity is higher for Hospitality. Hence, without doing any calculations, it is evident that the anticipated return for Hospitality's bond is higher. Furthermore, if the bond was to be purchased in the present and held till maturity, as the price for Hospitality's bond is $2.19 lower than Wyndham's bond as seen in the table. Additionally, the yield to maturity calculated using Excel for Hospitality is still higher. It is 4.19% compared to Wyndham's YTM, which is 3.61%. Therefore, by paying lower price, you are able to earn higher returns. Now we are going to talk about the 3-month Treasury bill. The average annualized interest rate for the 3-month Treasury bill is 0.59%, and the variance of the interest rates is 0.62%. This indicates that the risk is greater than the average return generated by holding a government T-bill. The monthly average interest rate, however, is 0.049%, and the variance is almost 0%, according to Appendix H. Therefore, when converting the annualized interest rates to monthly interest rates, you can see that there is no risk of holding a Treasury bill. This is because they are short-term securities with no interest payments. Hence, there is no interest risk. This is a great way to reduce risk in the portfolio. Since stocks and corporate bonds carry a lot of risk, T-bills can help balance the investments and reduce the overall portfolio risk.
So in conclusion, when constructing the optimal portfolio, including stocks, bonds, and T-bills, the weights on each security will vary according to investors' preferences. Nonetheless, the returns, yield, and credit rating is higher for Hospitality's bond. Therefore, it is a better option in contrast to Wintem's bond. Furthermore, in comparison to the other stocks, Mercado Libre is doing better, and that is demonstrated through its average rate of return and correlation with the S&P 500. Although it has a high variance, it has the highest average returns, and it is the second highest correlation with the market returns compared to the other stocks. Lastly, T-bills, as mentioned before, are risk-free securities. Hence, it is a good decision to invest in T-bills in order to balance the risks of the portfolio, even though the returns are not as high.